Welcome. Ms. Rivers, thank you very much for meeting with us this morning. As young tax consultants with your firm, we are honored that you gave us the opportunity to look at your client, Bartley Cummings, and look at his companies and do some tax planning for him. It has been an honor that you have trusted us with this, and we're really excited to present with what we've come up with. So to begin with, our client, Bartley Cummings, he is the owner of JDC, which is a company that started many years ago and has grown to now own 100% of the shares of WT Devices and WT Solutions, which are two businesses that have a lot of potential. And as you can see by the arrows, one is green because that business is profitable, and although its profits are slowing down because of some production issues, which we will be getting to later. And then with the red arrow, that business is currently creating some losses. However, Mr. Cummings believes that there is a lot of potential in this business. So I'd just like to kind of take us 2 steps back and actually say that Mr. Cummings, he's an entrepreneur, and from the notes that you've provided us with about his business, he is a very successful entrepreneur and a great visionary, and he has led his companies well so far. And he has expressed to us, through you, that he is just not interested in taxes. So that's where we come in. He gets to be the innovative, creative one within his specific business, and we get to work on the efficiency, because that's what we're good at. We're going to save him money by being efficient. And so I'm going to now let Clint take us into some of the current inefficiencies.
Thanks, Jessica. So as she mentioned, Mr. Cummings has done a great job growing WT and WT services in the GPS world. We have, however, come up with 4 main inefficiencies that it faces at this time. Currently, WT provides WT with free intercompany services at no charge. We feel this is a problem because the profits that WT is making cannot be offset by the losses that WT is experiencing, which has tax consequences. This is closely related to the second inefficiency, which is the uneven profits and losses between the 2 companies. As mentioned, the losses should be used to offset the profits so that the tax benefits can be fully realized in this situation. The third inefficiency we face is the quality control that is currently being faced now with Blanco. They are a Mexican company. They provide the GPS devices for Bartley, and we feel that if we were able to somehow fix the quality control that is faced by Bartley with purchasing these devices, he would be able to focus more of his time on the 4th inefficiency, which is to innovate and grow and build new ways to gain revenue. I'll get into these more thoroughly and the solutions for it. So first, free intercompany transactions. We feel that Bartley is not currently expressing the real business reality of the situation, with WT providing services for free to WT. There's a simple solution for this in that we can provide reasonable and fair transfer pricing for these services, which is closely related to my second point, in that there's uneven profits and losses for the company. This is bad because WT is being taxed to the full extent on their profits, whereas WD is accumulating loss carry-forwards that cannot be used to offset any of the taxes on anything because they're currently not receiving any profits. We feel that this is important because in order to pay the least amount of taxes, which we all want to do, we should have some way to even out these profits. And the first, as I mentioned, is transfer pricing. The second option is to combine the 2 companies. Or I guess it's not really a simple solution, but the expenses that WD faces would be able to easily directly offset the revenues that WD is gaining from its GPS sales. We do not feel this is a good option for you at this time because the fair market values and the book values of WT's assets differ so greatly where this would create a huge amount of capital gains that would be taxed on. And the other reason this is not a good option is that there are currently other business deals that Colin will get into at this point in time that may, and this, combining these two companies may hinder the outcome of those transactions. So the third point and the fourth inefficiency are kind of a combination of two things. So I'll solve them with one simple thing, and that is to purchase a manufacturing company or Barclay's manufacturing company for him. He had expressed a great amount of interest in doing this, so we feel this would be his best option because he would have complete control of manufacturing. He'd be able to focus his efforts more on the innovation and the growth of his revenues, as well as worry less time about customer complaints and things of that nature, therefore allowing his business to grow and improve to its full extent. I'll now pass it to Colin to talk about the two other business transactions that Barclays face.
So Quinn talked a lot about what the current business situation is for Barclays and his group of companies. And what I'm going to talk about now is moving into the future, how we're going to organize these companies, and then the possible partnership and the acquisition that Quinn briefly mentioned. So these are the two items here, and this is the acquisition of Blanco in Mexico, the manufacturer, and we're also considering, or Barclays is considering a partnership with Zombie. And what we're going to look at is to try to minimize the tax consequences of these transactions. They're both things that Barclays expressed keen interest in, and being such a successful business person, really realizes the benefits of these moves. And so all we're going to do is facilitate these moves for him to be the most advantageous moving forward. So let's take a look at the first issue, the Mexican company. Obviously, when you get into different countries and different ways of doing business, it gets extremely complicated with all the international rules. Luckily at our firm, we have international tax experts to handle this going on. But we're going to talk about just some of the base level things that should be considered right away and brought to the client's attention so that he can go ahead and start brokering these deals with the different companies. And the first bit is the tax difference. Currently, Blanco is a company that has about a 5% corporate tax advantage over the Canadian counterparts. And so basically the money earned there goes farther. You get more bang for your buck with the dollar earned in Mexico. And if we were going to have Barclays acquire this company, when that money comes into Canada, this may not be seen anymore. What happens is that when a Canadian-owned company has business in a different country, you start getting taxed in both places. Now, this is not to say that there's double taxation occurring. Canada and Mexico have quite a good relationship, and there are tax treaties there which are going to allow this money to be taxed the correct Canadian amount. And there's foreign tax credit procedures to ensure that this doesn't happen, this double taxation that we definitely want to avoid. So when approaching the client, we have to stress to him that this isn't going to be an issue moving and acquiring a Mexican company as far as taxation goes. Now, on the business side of things, Barclays really wants to innovate. He wants to have the best system. He wants to be able to continue growing his business. And that's part of the motivation for acquiring this company. But the way he wants to do the innovation is a little bit different. He wants to have the research and development done by the Canadian companies and then use them in the Mexican one, essentially. And once again, like Ben talked about, is the transfer pricing issue. And so when this occurs, we're really going to have to look where the money is best put and where the taxes are best to be applied. And so when you're doing the research and development, if there are tax benefits for expensing it in Mexico, once again, we can charge them for it and even out some of the profits and losses based on the different situation. Also, going forward, we know that Barclays is not close to retirement at this point and still a viable business person. But when you end up selling your business at the end of its life, there are huge tax advantages to being a small business corporation and making use of the cumulative lifetime capital gains deduction for selling the shares of a small business corporation. Now, one of the criteria to qualify for this is to have an active business carried on in Canada. And if too much of the business is carried on in Mexico, if the percentages don't line up, then this is going to be a problem. This has had very high tax consequences in the future without being able to make use of this deduction. So Bartley needs to be cognizant of that. This isn't to say that they shouldn't acquire the company, but in the future, he should be aware, made aware, that this could have consequences for him, so he can make the best decision for himself. Now, moving on to the second issue with Zombie. Now, this company is one that is looking to do a partnership with WD. And the reason is that WD simply just needs more capital. They need an equity partner to continue growing the business and work hard. And we see this partnership is unavoidable, even though the growth aspects of WD look great in the future for Bartley. But they're only going to be able to be achieved if we take this partnership and he's able to get this capital and grow the business, even if it means splitting the profits in the future. And right now, the way he suggested is just selling off the shares. This is going to have major tax ramifications. You're going to pay out about $190,000 worth of tax if you just sell off 50% of the shares as is right now. Obviously not something that we want to do, especially when you're only selling the business for $1.5 million. That's an incredible percentage of that, and it really, again, hinders the growth. You're not going to be able to have as much capital going into the business with such a high tax bill. And so the reason for this is that there's large accrued gains on these shares of this company. The company was started with nominal share capital, and so the book value is only about $100, while the entire company, WD, is worth $3 million. So you're going to have a huge taxable capital gain. So we need to look at ways to reduce this. And the way we're going to do this is by increasing the average cost base of those shares. Now, for example, one way to do this, if we continue on, is to perhaps declare a stock dividend. Now, what's this going to do? It's not a physical dividend. So you're not going to be having cash go to the company. It's just going to be a stock dividend. And what this is going to do is increase the ACP of the shares. And if you do this, you're going to have a smaller gain because all of a sudden the value of the shares on the books is a lot higher, and so the gain is going to be reduced. So if we were to declare a stock dividend and get the ACP up to about $2 million, obviously the amounts need to be taken into consideration and what needs to be done for the best of the company. But we're going to be able to reduce that tax bill. $62,000 looks a lot better than $190,000, especially to someone who's as money cognizant as our client. And you know, this is something that's very complicated, these intercompany transactions, and there's a lot of different ways that you can go about structuring these deals, taking different percentages of the company, and Bartley was open to that. But one thing that we're going to stress again with this partnership is that he doesn't give up more than 50% of the business. This is for a couple of reasons. One, obviously, lose control. Secondly, if you give up 51%, you're going to have to invoke what's called the acquisition of control rules. And this is going to create huge gains on the asset of the business as they're going to be required to be deemed to be disposed at the fair market value. And as we've seen on the balance sheet, once again, this is going to have major tax consequences and it's not going to be something that we're wanting to see in the future. And now, so, as we move on through the presentation, Jessica's going to take you through some of the more personal considerations for our client and kind of his future.
Yeah, so of course, now that we've gone through in some detail the company considerations, which are of course key, we also like to take a step back and go to the personal side of things. We can't always look at numbers, and of course, Bartley, and on top of being an excellent businessman, of course, wants to enjoy his later years of life, especially after such hard work and such success. So first of all, he expressed a desire to purchase a vacation home for himself and his spouse. And he would like, over the course of the next few years, to take $1 million away from the business. He has been living on inheritance, so he hasn't actually been taking any money away from the business. However, he did give the business a $2 million shareholders loan to start off with. And then the second item is the future sale of the company, which he has expressed he's very much the entrepreneurial spirit. He wants to keep going for many years to come. But with such a large company with various assets and as complementary and fit into some different inefficiencies that we're going to be tweaking and changing things, it's very important that already we start to think about future retirement. So to go into the $1 million vacation home, we kept it very simple on this one. He has given a shareholder loan to the company, and therefore he should just ask for it to be repaid. Of course, there are many ways he can get money out of the company. He owns it. He can pay himself a salary. He can declare dividends, combinations of both. But there's a $2 million shareholder loan that has been interest-free. So if that loan is getting paid back to him, that would be a tax-free basis, and he is definitely not in the lowest tax bracket at the moment, and might not be for many years to come with his retirement income. He's a gentleman in a very good situation. So this is the simplest, best thing for him to consider doing to start off with. Next, we'll go into the sale of the business. So first of all, let's just look at our little timeline. Current restructuring, that's what we have gone into detail about, and mentioned inefficiencies and calling that into the restructuring. So with these new businesses, of course, comes many opportunities for growth and innovation. And with that comes unimaginable consequences with even future growth and innovation and mergers and anything that can come along the way to further enhance the business and make it more productive and profitable. And finally, then the sale. Who knows how many years in the future, but it's something to think about. Now, the tax consequences are, like I mentioned, impossible to guess the exact amount. And at this point, we just did a brief analysis, and we would just only like to suggest that once he does sell the business, he considers selling it incrementally. Meaning, he set up with the purchasers, whichever company might be buying his businesses, and he creates some kind of share structure, and instead of one big purchase or big sale for Bartley, he just incrementally sell off a few shares at a time, which will give him the stream of income, so he can manage his tax brackets accordingly to whatever income he and his spouse might have. We did not get very much information about his spouse, as she is not a part of the business, so there are no opportunities to pay her a salary that would be liked by the Canada Revenue Agency. And however, she can own some of the company, and that is something, of course, though, that would involve him selling her shares, which would create a gain for him. So there's just many little increases that he could come across, but our big recommendation is incremental sale. So next off, we would like to just kind of give a big overview of what we said. We have looked at the Bartley and GWTS, and first we looked at their inefficiencies. There's some transfer pricing issues that need to be addressed to make the best use of the business. In both businesses, there will be transfer pricing that would kind of, like as Clint mentioned very well, paint a more representative picture of the company. And then next off, Colin went through the business opportunities with Blanco and Zombie, and the best ways to make sure that those businesses can be joined by the company or be bought by the company in the most tax-efficient way. He also mentioned the importance of making sure that Mr. Cummings is eligible for the cumulative capital gains deduction. And finally, I took him through the personal items about his vacation home, because while he didn't express concern that we be sure to get there, we really feel that with tax, you cannot force yourself to just look at the numbers. You really need to make it a personal thing, because this is Mr. Cummings' life and his business that he has grown, and we can't just leave out the personal issues. So with that, we would like to thank you for your time, Ms. Circus, and thank you again for the opportunity of giving us this chance. So, thank you very much, and we'd like to answer any questions.
You talked about possibly combining, or you showed that as an alternative combining these you said it's not going to best one of the losses just talk about it because of the potential liabilities that you have from the people. Is there a way that you can defer the taxes or incur the taxes
There would be, and this would be to make use of the Section 85 provision. You could set up a different company and have those two exchange their assets for shares and then run everything through that company as well. However, the main reason that we stay away from that is that he has these two tentative agreements on the table, and for those, especially the partnership, they agreed to buy half of a company that would no longer really be a company, it would be something else. And so we didn't feel that we wanted to jeopardize this agreement for the client at this point in time. If that doesn't go through, or if perhaps Zombie is open to buying maybe a smaller percentage of a larger company, then this is something that can definitely be looked at and would be tax advantageous, as you said, where you'd be able to have full offsetting of the expenses and the revenues.
One of the things you mentioned he's going to do is that he's going to go apply this is going to go up in or debt from the bank, obviously certain on that. And the interest expense is going to be paid for the bank loan is going to be made up of GWTS, and so it was going to incur interest expense there. Is there any way that they can, use that interest expense?
Yeah, once again, probably the best way to do that is to look at taking the loan from a company that has revenue. So if you're able to do it perhaps at WT instead of the bank, then that interest expense would be against profit rather than just a holding company that holds the shares of two others and has no tangible profit itself in the income statement.
The research and development would actually take place under the WD Solutions. What would happen is that WD Solutions would be doing all the research and development, and with the purchase of Michael, they would be able to sell the outcomes, so to speak, to that company, maybe creating profit, or since they'll be owned by the same person, maybe it would be sort of nominal, but the research and development would take place in that.
You also bringing this stuff, future sale of the company, is there a capital communication where perhaps you have to bring this stuff now? You mentioned that in this business and capital costs rather than making it for sale.
We didn't look specifically very much into the spouse. We kind of toyed with the idea, yes, of her owning some shares, because since she has had no part of the business to date, she isn't expecting the payout, so to speak, in retirement that he would be, and therefore, if there was a way to get her the shares without creating a large gain for him at this point, which we do not want to do, then of course splitting the post-sale payout of the shares would be beneficial.
One of the things you mentioned, one of the plans was to, on the sales of Zombie, was to declare stock to increase the cost of the shares. What would be the tax consequences
For the stock dividend, what would happen is that since cash is coming in, you would declare a revenue, but you wouldn't have cash appearing in your balance sheet. But between companies, there's advantages when companies are paying dividends to each other and getting to deduct them later on. Once dividends hit the personal level, they're taxed much higher. So looking at it, they're raising that ACB provided a greater advantage, we feel, than rather than having tax consequences.
That's all the time we have for the